Hi, this is Zhang, and I'm here with Neal Bawa, and we're going to get right into it. Everyone knows you, Neal, so we're just going to start right into the Q&A. And really, I'd like to touch on probably four themes, and then we'll jump into questions from people. So I got probably 100 questions, and almost every question revolved around this. What is your current investment strategy? Property type, class, location.
hmm Perfect. Um, I have to be honest, this answer has evolved in the last 6 months, almost as many times as we've seen increases and decreases in cases across the US. So I think this is version 9 of my answer because I get asked this question a great deal. Um, I believe that today, looking at the market and looking at the market going front, we have to look at what our time frame is to evolve our strategy. So ask yourself this question as a syndicator: are you the kind that wants to get out in a couple of years? Are you want to, do you want to hold the asset for a longer time frame? Because on a fixed loan, interest rates are absolutely mind-blowingly low, right? If you're going into a 10-year asset class, that really is going to drive everything, because the amount of money that you can make on a single asset that you hold on to for 10 years with a fixed, you know, sub 3% loan is quite astonishing, right? Yeah, I don't know how many of you guys have actually done 5-year, 10-year analysis looking at, a 3% loan. It's really astonishing because some of these loans, you could actually keep cashing out investors over, over time as the rents keep going up. So to me, I actually have a dual strategy right now. One of the things that I'm doing is I'm absolutely doubling down on tertiary markets. And a lot of you have this immediate negative reaction to tertiary markets, like tertiaries. He really, did he say the T word, the dirty T word?
I almost hurt myself there when you said that word.
I
No,
know.
but
So my answer is that tertiary markets have in the past proven to be very volatile, right? And a lot of that is because of jobs. But if there's anything that we should learn, if there's one thing that we should learn from COVID, is that COVID has massively accelerating an existing trend. And that trend was people working from their homes, right? And maybe they weren't working, maybe before they were working from home 2 times a week, and now they can actually work from home 5 times a week. Not every job's like that. But if 5% of the jobs in the United States went from part-time working at home to full-time working at home, and current projections are that we're going to come in somewhere between 3 and 5%, you realize that that is 5 to 10 million jobs. And then there's a significant portion of those that are going to go into tertiaries that have a very high quality of life. So my current investment strategy is to look at tertiaries with very, very high quality of life, very reasonable prices. My first pick is Idaho Falls. So Idaho Falls is the second largest city in Idaho. And I'm looking at that marketplace going, this is the exact kind of product that I want. And I'm buying Bs in Idaho Falls. Why? Because I can afford to. That's a stupid answer. I know it's a stupid answer, but if I can go into a tertiary market and that gives me a lot of benefits, why would I want to still take the same level of risk by buying Cs? In a tertiary market, you can actually buy a B and reduce the amount of time that you are spending. We tend to be extremely aggressive asset managers. We have armies in the Philippines. We've got US-based asset managers flying out to our asset that are full-time employees of ours. So what we're looking for is, can I get a property that's a no-hassle property with still reasonable returns? So I'm looking at tertiaries and I'm looking at, B properties. Now, as far as location is concerned within those tertiaries, in a tertiary, location doesn't matter as much as a secondary or a primary, because in primaries, you tend to have a huge variability between locations. You'll have a class A block and then you go over the freeway and all of a sudden it's a C, or sometimes even a D. Sometimes it's a war zone, right? That level of variability is very rare to find in tertiaries, just so you know. There's obviously going to be a few war zone or tertiary, other side of the rail track sort of thing. But for the most part, tertiaries do not have the variability. So the sublocation doesn't matter. And there's so many good tertiaries in the United States. One that I would recommend to my friends that are close, that are on the East Coast, is Greenville, South Carolina. I have profiled this market a great deal. It is on this freeway that connects Raleigh, Charlotte, and Atlanta. So it's kind of in between, you know, Atlanta and either Charlotte or Raleigh. And when you look at that, it's actually in South Carolina, but it is part of North Carolina's very buoyant economy. Now, I'm not suggesting that all of you run off right now and go buy stuff in Greenville, South Carolina. That's not my suggestion. I don't have a lot of assets there, just one. Point is that there are markets like this in tertiary markets that are now going to become much more lucrative than they were pre-COVID. Because here's the fundamental belief, and do not do any of the stuff that I'm about to say if you don't share this belief. COVID has short-term effects and long-term effects. The biggest long-term effect of COVID is that you're going to have some metros where people are going to move out to the suburbs. And there are going to be some metros where people are going to move to other metros for a better quality of life because they can. Because 3 million CEOs have received a masterclass on how to run their companies remotely in the last 4 months. Even the next 20 years, we wouldn't have 3 million of them receive that masterclass. And they've all received that masterclasses. So in my mind, that's a one-way street. We don't come back from that. As a result, today, secondaries are worth more than they were 6 months ago, and tertiaries are worth a lot more than they were 6 months ago. That is our hypothesis, and we are following it to the T. I have a flight in the middle of COVID to Idaho Falls 12 days from now. I'm going there to look at properties. I'm going to look at Rexburg and Pocatello and all of those sorts of places. And people might say, why Idaho Falls? Well, my first answer is Utah and Idaho play this flip back and forth game of fastest growing and second fastest growing state in the union, right? So anyone can go to Google and say, what's the fastest growing state in the union? Depending upon which link you click, it's going to be Utah or Idaho. So that's number one. Number two, Idaho Falls has some astonishing things happening that are multi-billion-dollar investments where the money is already allocated. I generally stay far, far away from future stuff, future investments, future this, future that, except when it's government and the money is already allocated, because that tends not to get yanked away. That money is already allocated, so you should look up Idaho Falls and its economy. Idaho Falls also was the only city in the United States that I'm aware of, could be wrong, that gained jobs during the last 5 months. So every city in the US, every county in the US, every state in the US has lost jobs, bar one, right? Greenville, South Carolina also lost jobs. So I'm chasing jobs, and my investment strategy is so hyper focused on jobs right now that for the moment, I'm not even looking at population growth, even though Idaho Falls does have astonishing population growth. For the moment, I'm saying my investment strategy needs to be focused on job volume.
So usually the challenge with secondary, tertiary markets, I would say, is typically two things. One is rent growth, just because the number of jobs out there limit the amount that you can push rents. Like if you buy a deal in Dallas and you want to push rents $200 a unit, you can probably do it because you can find a different tenant base. But if you go out to a secondary, tertiary market and you try to take a 300 unit deal and push rents $200, it might be harder. There might not be the tenant base to do it. And then I would say the second thing is liquidity. So not who's essentially, like when you go to sell, at some point you're going to sell. When you go to sell, is there money behind you going into that market? So how would you address those two?
Both are valid concerns, and I'm not going to give you 100% answers to those, because I'm going to simply say that regardless of what I'm about to say, these are valid concerns, and you should know that there's no completely getting away from both of these. James, you're really good, because those are the two big concerns going into a tertiary that aren't fully addressed by COVID. Some of the other concerns have been addressed, but these two aren't. So number one, your rent growth in your models has to be a little moderated when you're going into a tertiary market. So you're probably going to bump rents by 120, 130, 140, rather than the 160, 170, 200 that we are used to seeing. So know that and account for that. But also your expenses are going to be more moderate. So keep in mind that there's pros and cons here. These markets have benefits. Also, the other thing that you can do with tertiary markets is you can account for a longer tenant stay. So if you look at a tertiary market and compare it to a primary, in a primary, people will stay for about 18 to 20 months. That's the national standard, according to the NHMC. But in a tertiary, you can actually go into 30, which means that you can be more aggressive on the expense side. You're going to have lower expenses because your turn costs are going to be lower. And we see that being lower all the time. So that's one piece. The second piece is this. What we just did in the United States is so ridiculously unique. We pushed $4 trillion into the US economy in 5 months. That liquidity will force secondary buyers to push into tertiaries. We are already seeing that. If you look at the last 5 months, tertiary market cap rates are dropping faster than secondary, which are dropping faster than primary. Actually, we haven't seen any cap rate, drops, compression at all in primaries. Some primary markets are seeing cap rate expansion. So we're seeing, New York, for example, the cap rates are going up. But if you look today at tertiary markets in the last 5 months, go into CoStar, hopefully you have a national subscription, you're gonna come away with a sense of awe and a sense of shock at why in God's name are people buying these assets in complete standalone markets? And the answer is the liquidity that we forced in the market is absolutely forcing that to happen, because there's no way there's enough assets in secondary markets. So I don't think that a primary buyer is buying in Idaho Falls. I don't think a primary buyer will ever buy in Idaho Falls. But I think the secondary buyer is being forced into the tertiaries. Like, for example, Tucson is a true tertiary, right? Because it's 90 miles away from Phoenix, 95 miles away. That's a true tertiary, has to be. But look at what's happening to cap rates in Tucson. We are seeing new markets emerge. Like Fort Collins has all of a sudden become red hot because of this, and that's a tertiary market because it's more than an hour drive time from Denver to get to Fort Collins. The same sort of thing is happening in Texas, in places like New Braunfels, right? So in that San Antonio Austin corridor, you're seeing that market become all of a sudden very hot. I don't know if it's a true tertiary. In my mind, New Braunfels, you can say, well, it's part of the San Antonio metro. It's 40 miles from Austin, so maybe it's not a true tertiary. But markets in Central Florida that are true tertiaries, like Lakeland, are seeing cap rate compression post-COVID. Bottom line is, the thesis is this: cap rate compression will accelerate in tertiary markets and provide for your exit. So number one, I'm saying that 5 years from now, there'll be more buyers in tertiaries than there were in February. That's what I'm saying. And I'm not saying it's a huge number of increase, but there's going to be a substantially higher buyer. Number two, I'm betting that the cap rates will be substantially lower. So to me, I think both of those will aid your exit. Having said that, that doesn't truly meet my concern that I could be stuck there for a while. So I'm really looking at asset quality to protect me in case I do get stuck.
So asset quality and long-term debt, and then you feel good because you can sit there and cash flow 8 to 10%
Exactly.
while you wait. Okay.
Exactly. So that allows me to have some kind of a fallback. But on the plus side, here's my belief. Today in the United States, there is no way to 3x an investor's return in 5 to 6 years, except for going into tertiaries. So I may be wrong on my tertiaries and I may make a loss, but I think that overall, when you look at 1,000 tertiaries in the US and 5,000 syndicators, the biggest money is going to come from the tertiaries. That's my premise. That's my strategy.
Well, this was my first question and I've already been surprised. So let's keep going. Second question, operations during post-COVID, collections, leasing, management.
What we've done, and you're going to hear 50 answers to this question, during this summit, during this event. The collections answers, the management answers, mine are really not going to be different from others. So I'm going to just focus on one of them. I'm going to focus on leasing because I want to give you unique answers that you haven't heard before.
Okay.
What we've done on the leasing side is that we have started to route leads to a call center in the Philippines. And we were doing this for some of our properties, but we've accelerated this because what we are finding is during the pandemic, leasing is going to become key over the next 6 months. we are of the belief that we have not seen the worst of this. In fact, we are of the belief that September is the first of the worst months, because in July, we had the end of unemployment. That means people had money in their pockets in August. They don't have money in September. The NMHC and Freddie Mac just issued warnings in the last 10 days saying, hey, September collections are significantly below August nationwide for Class A, Class B, Class C. I saw them divided up by CBD, by downtown, by walk-up assets, suburban assets. Whichever way you slice it, rents in September were significantly down from August. And that wasn't the case for every market in the US. There are markets where rents are going up, but overall the US rents are declining, and they're beginning to decline faster now. So we think September is month one in our crisis. That's our belief. And when we're looking at that, we're saying we need to keep leasing very strong. So what we're doing is we're spending a lot of money on leasing. We're adding to our advertisement budgets, and we've issued a 5-minute phone call rule. And that rule is, when a lead comes in between 8 a.m. and 8 p.m. on a working day, within 5 minutes, we have to call it back. And in most cases, we want a phone call and a text message within 5 minutes. The only way to achieve that is a call center. And as it happens, I own a call center. So I'm using that call center to drive traffic to the property. Now, a lot of people might say, do I need to change out my property manager? No, I'm not even thinking of changing out my property manager. I'm just making sure that we get access to AppFolio or Yardi or Lead Pages, whatever, whatever it is that they're using. And we are plugging appointments directly into it. And that's adding about 40 to 50% in terms of footfalls to our property. Doesn't matter how many appointments you set. The only thing that matters is how many people show up, right? And those extra 40 to 50% footfalls are increasing our occupancy, our physical occupancy, because the economic, we no longer have 100% control over that. I'm not even sure if evictions are going to be possible in Q1 next year, let alone Q4. So I'm just shoring up my physical occupancy. So right now our focus is on lease at a very, very high rate and be extremely aggressive about it. I'm happy to report that our assets, our value-add assets are at all-time physical occupancy highs because of this 4 months of continuous pushing on leasing. They're nowhere near all-time economic highs, but I think that's to be expected.
Right. All right. Next question, raising equity. Mm-hmm. Building, maybe touch on how you're building your investor network, and mm-hmm. then how should other people start if they're just starting now?
Sure. We build our investor network one investor at a time. We've never worked with a money raiser. We've never, done anything like that. We've never had a high net worth investor, and we've never taken money from family offices. And this is a deliberate strategy. A lot of people think they have this dream that we're going to find this one high net investor and he's going to pour millions of dollars into our properties. I can tell you, while it has happened to some of my colleagues, it is so rare that it is not a strategy. It's hopium, and hopium is never a strategy. So to me, just ignore that. I mean, I'm at the point where I have a total of 23 executed assets. I haven't found that investor. So it doesn't happen very often. And we have outstanding, glowing reviews from investors who've made 24% annualized from us that we plastered all over our website. We still haven't found that person. Secondly, family offices are absolutely not a channel for you. The number of syndicators that actually get substantial amounts of money from family offices is so tiny that until you've been in here for 6 to 7 years, you're not going to get it. So what does that leave? It only leaves one kind of network, and that is the individual investor, right? So that's the network that you're looking to build. That's where you're looking to go and grow. Bottom line is this: I find investors, like folks like you that are looking to get started, not being intentional about the act of building a network. And you've really got to understand all the different pieces of it. So a really great place to start if you want to be intentional is the Ultimate Sales Machine by Ryan Deese. So you've got to first get your mindset right? The Ultimate Sales Machine by Ryan Deese, D-E-I-S-S, is a master book on building that sales machine, in this case, your investor machine. So read that book. It's going to get you to the starting line. It's not going to get you beyond that. But then start to be intentional. I'm going to give you an example, and you can apply this example to 10 other things. Pre-COVID, and post-COVID is even better, but I'll give you a pre-COVID example. I used to go to a meetup group, right? So, it's a local meetup group. There were lots of people there, 100 people. And I would see other people that clearly were trying to become syndicators. They would walk in there, and then they would basically talk and get 5 or 6 business cards. And it was a terrible waste of their time because people are not intentional about money raising. So I'm going to now describe to you in the next 3 minutes what I do when I go to a meetup. Now, I don't do this any longer because I have full-time, investment relations managers, but they do it, right? So I walk in, it's about 6 p.m. I walk into a meetup, and I'll also at the end tell you how to do this in a virtual meetup because that's what's happening today. I walk into a meetup, and the first thing I do is I arrive about 15 minutes earlier than anyone else. This is very important. So I come in early. I introduce myself to the person that's having stuff written down. I joke with them so that there's some face connection between me and them. The next thing is I go and find the organizer. I offer my help, right? What can I help with? Do you need wiring? Do you need any help? Most of the time they say, no, we're all set. But that builds face value. Then I introduce myself. Then I thank them for putting together this meetup. I do this every single time I go to the meetup. Why? Because I want to present at this meetup. And the only way to do that is to first build an emotional connection with the organizer. If there's 2 organizers, I repeat this process with the 2 of them. Then the next thing that I do is I only go to meetups that have some way of doing haves and wants. Haves and wants is a very powerful thing. You get to be the presenter for 1 minute, right? They give you 60 seconds to stand up and say stuff on haves and wants. What I'm constantly shocked by is people who are trying to become syndicators never bother to write a 60-second script, which is a capital mistake. If you were told that you had a chance to present to the biggest venture capitalists on the planet in Palo Alto, right? The Google guys are sitting there, the Apple guys are sitting there, and you only had 60 seconds. I bet you would spend an entire day crafting the best message. It's called elevator pitch. But I have not heard any of the people that are in the syndication business craft that 60 seconds. The message needs to be clear, crisp, smooth, continuous, and have an emotional hook to it at the beginning and an emotional hook to it at the end. Nobody bothers to spend time to craft this 160-second message. I've crafted multiple ones. And I basically—
Can we hear it? Neal, can we hear it?
Well, at this point, I haven't done this for a year, right? So bottom line is I'd have to go back and revise them. I do not admit to kind of having, these in my head. So what I do is I've got them on the network, and I go in there and I read them before I leave for the meetup. And many times, and this gives you an idea of how attention deficit I am, I print it and take it with me in my pocket. And then I actually go to the bathroom right before they're finishing the presentation of the main presenter, and I read it once more. But my goal is very simple in this 1 minute. Hello, here's what I do. I'm a syndicator. What do syndicators do? We buy large apartment complexes, and we hold them, and we improve them, and we provide phenomenal cash flow to all of our investors. Hundreds of thousands of investors in the United States are using the benefits of syndication, blah, blah, blah. Go on and go on, right? And at the end, I basically say, if you are interested in learning how multifamily properties make money, then as soon as this presentation is finished, I'm going to show you examples in the back on my iPad. On my iPad. And I hold up my iPad, which has pictures of apartment complexes. These are not my apartment complexes. These are just pictures of apartment complexes, nice ones, right? And as I'm showing this, it is in that screen show mode. So it's actually flipping through apartments. And I walk and I kind of move my hand around, and I make sure that I connect my eyes with as many people as possible. So as people are watching me, I'm showing this to them. Now, I try to do, so as soon as the main presenter's presentation finishes, I move to the back of the room. And if it's a central aisle, listen to how intentful I am. If it's the central aisle, so let's say there's one aisle down this meetup, I go to the last row and I stand right in the middle of that, essentially blocking everybody that's coming out and going to the bathroom. And I stand there with my iPad. And then, as you can imagine, 1 or 2 people will come up and engage me in a conversation. And then what I do is I start showing them stuff on the iPad. And I've got a very simple presentation on the iPad because, you know, you can't really show presentations or numbers. I basically just show them, these are my assets, these are my assets, these are other assets I'm considering buying. When I was new, I was just saying, these are assets I'm considering buying or underwriting. These are the sort of assets. Now, why do I use the iPad? And I actually use an iPad Pro that's 13 inches. So it's a huge iPad, right? Why? Because human beings are suckers for someone showing something on an iPad to people. Within 45 seconds, there are 15 people clustered around me, almost as if I'm giving money away, right? And now more people cluster around me because they're like, what the heck is this guy showing? And I'm going to try and figure out what he's showing. So now I've got a massive number of people around me, right? Intent. What's the next thing that I do? As I talk with people, I show this to people, you know, this apartment complex, this, and then I lock my eyes with somebody and I say, would you be interested in buying this property? I don't tell him if they should be interested in investing with me. At this point, he's not sold on me. I want to know if he's sold on multifamily. So I say to he or she, would you be interested in this? And if the person says yes, right? Here's what I do. I take my business card, which is already in my pocket, and I take it out and I hand it to them. Now that person raises his hand and tries to get the business card out of my clutch. And I hold it and I say, no, I'd love your business card. Now at this point, with 15 other people watching, it's too embarrassing for them not to give me their business card. So guess what they do? They take my card and they hand me their business card. Now, 60% of people going to meetup say, I don't have a business card. Most of them do, but they don't want to hand it to you. So in my other hand, remember one hand, left hand has the iPad, the right hand has a tiny little notebook. This notebook has a piece of thread and a pen attached to it. Always, always attach your pen with a piece of thread because otherwise you're going to lose your pen in a second. Right? So now what you do is you say, oh, don't worry about it. Here, why don't you write your name into this book? So I hand the little book to them. And then I move on to the next person and say, would you invest in this property? Because the other person is now writing in the book, right? Now, just because the person's writing in the book, sometimes other people, for whatever reason, I don't know why, they actually take the book from that person and start writing in their information, as if I'm giving something away for free. It's because this is all intentional. I'm there to collect information as rapidly as possible, right? So I walk through this whole group of people trying to get people's information as quickly as I can. And guess what I do then? I simply look around the room, find the largest cluster that anybody else has, and I go join that cluster and repeat the whole process. Once again, with my iPad, which is turned up to 100% brightness, attracting attention. I could go on for 30 minutes about this. But how many people listening to me right now have ever even done 5% of this? It's about intent. That's how you gather databases.
I love it. Nobody's been that detailed in meetup strategy, but I love it. I'm going to go to the last one before we jump into questions from the group. Winning deals, whether it's on market, off market, and then if you are a new syndicator, what would be your advice to winning a deal in today's market?
I think that the folks that are winning deals today are partnering with folks that are already in the market. I think the biggest thing that you could do that will save an enormous amount of your time is go find properties, but partner with people. And I can tell you that that will accelerate the process. Early on, it doesn't matter what percentage you have. I can tell you this, you getting 100% of a deal by yourself is not going to make you as much money as you getting 10% of a deal with another syndicator that's experienced. And you might say, really? 100% versus 10%? The answer is, number one, that 100% deal is fictional. You're probably not going to get it done. Number two, if you do get it started, all the money in there is just pro forma money. You don't know enough to achieve those returns. You might even end up losing investor money. So my advice to you guys is early on in the process, understand the value that you can bring to existing syndicators and join them. There are three big values that you can bring in. Number one, you can raise money for them. Number two, you can find properties. And number three, you can come up with earnest money. You'd be surprised at how many established syndicators don't have earnest money. You know why? Because they've already got earnest money out on other deals, right? They're not keeping multiple $300,000 pools of earnest money. And you might say, but that means I have to come up with 300,000. No, you don't. You simply have to come up with one of your potential investors who comes up with the earnest money, and then you'll split your portion of the GP with them. Does that make sense? So I see very, very few people out there offering this strategy, even though it's really simple. You have to convince one investor that their way to become a general partner while doing nothing, and it's completely legal, by the way, completely legal to do this, is to put earnest money at risk. You do nothing else, right? So this is a person with money, but not with time. Technologists, doctors, other rich people. You convince one of these people, and now you have a source of earnest money. Now you can go to existing syndicators and say, I can bring in the earnest money risk so you don't have to risk it. And now, because of that, this syndicator will go make more offers than they're currently comfortable with, because they're using your earnest money to be able to make multiple offers at the same time. And you'll get access to their network. That gets you projects.
So I'm gonna take a pause here from the screen sharing and open it up to questions from the audience. If you want to ask a question to Neal, I've got 40 questions behind this slide, so I'm happy to keep going at it. But if you want to, I guess try to raise your hand, and I can unmute you. And if you have a question for Neal, we can have you fire it away. Or I'm gonna start calling on people.
There you go. I wanted to
I have a question.
at some point, James, I did want to talk about how to use that meetup strategy with virtual meetup. So we'll allocate 2 minutes, but go ahead. Yes, with your question.
Just regarding the earnest money, let's say, you know, you found someone or you yourself is interested in becoming a general partner. How do you figure out that that person is a good, you know, person to partner up with? Like, what are things that you need to evaluate to go in full with this person?
To be honest, if their role is to give earnest money to a project, that is the easiest kind of partner to evaluate, because what they're doing is an extremely narrow thing. So all you want to make sure is that this is not a person that's very paranoid. So that's the only thing that I would care about. And they actually have the money that they're talking about having. It's not their grandma that has the money. It's not their sister-in-law. It's their money. It's in the bank. And they're not a paranoid person that's super paranoid about this because they're, you know, obviously taking a risk. I think that figuring out which syndicator to partner with is actually more difficult, and you should spend more time on that, because there you're getting into a marriage, right? The EMD guy is simply a channel to get you in. I can tell you that your earnest money partner is going to be happy with you if you pick the syndicator wisely, because all the action that is happening on this property is under the control of the syndicator, right? If the syndicator does their job well, issues regular updates, makes the necessary corrections, your EMD person is going to be really happy. So I don't think that you really need to go nuts over qualifying your EMD friend.
No, I meant in terms of qualifying your syndicator. I mean, I have the earnest money. I want to see if I've got the right person to do the job. So how do I make sure that this person will do whatever, you know, what you just listed? Those are just a couple of things, but what can you do to go deeper?
So you can either try to find that syndicator's investors, or you can try to find that syndicator's bankers. Bankers are easier. You know, you can go out to, you know, lenders that you know and say, hey, can you tell me who did this loan? Which is, you know, that syndicator's last 3 projects. You go talk to their bankers. Now, when you call the banker, let's say James Zheng is the banker, right? The worst thing that you could do is say, hey, I'm calling to do a reference check on X, Y, and Z. That's never going to work, right? But you talk with James about properties, about what's happening in the marketplace. Maybe you add some value there. And then you basically, you know, finagle a question about that particular person and saying, hey, I'm considering working with them either as a limited partner or as a general partner. What's your opinion of this? Where do you see the risks? If you position the questions properly, you'll get a straightforward response. So lenders would be my first pick. Now, finding investors is more challenging, but actually one way of doing it is reaching out to that syndicator through your spouse, through your friend, anyone in your network, and say, I would like you to reach out to this syndicator as an investor and ask for a reference to 3 investors, right? So we want a reference to 3 different investors. Now, please keep in mind that they always give you reference to the people that have had experienced the best of them. So if those people are not absolutely effusive and glowing in their praise, maybe you want to just walk away, right? If I had the option to pick my happiest investors and they were anything less than gaga, that's not a good thing.
Any other questions out there?
Thank you.
Sure. I have a question. Hi, Neil.
Yes, Alex.
Alan Stewart here.
Yeah, go ahead. Dylan.
So, I know that you have a call center in the Philippines, and I'm sure that, that took some time and thought to put together. And at a certain point, you had a certain scale, where it made sense. Curious what your thoughts are of some of the new technologies out there, like the virtual humans, a little bit more than the bots that sit on a website and can interact and have a bit of a presence. If you've looked at any of that and how that might parlay with your call center.
I've experimented with them for smaller projects. It hasn't worked well because they don't know real estate, and you can teach them real estate, but by the time you're done teaching them, they switch out that person with somebody else, and then you start all over again. So it's very challenging to get to a stable state.
So you rather have real humans right now, Neil?
Well, those are real humans too, but I'd rather have real humans that are on my payroll.
Right.
Fair enough. Thanks, Neil.
Any other questions before I get to the fire round with Neil here? All right. Let me see if you guys should be able to see my screen. All right, Neil, we will do maybe quick 30-second to 1 minute answers on these. Does that sound good?
Yep.
All right, here we go. All right. Investment strategy for 2021. Has it changed post-COVID? I think you hit that, but
Yep.
Any other additional comments? Tertiary markets. Tertiary for Neal Bawa. Is that the theme?
Yep. I think that's big enough. I think I don't think you're going to hear that in this summit often.
I was not expecting it.
I believe that, what's interesting is I used to be very focused on Class C, and I think I've learned quite a bit about Class C from COVID itself. To me, I think I'm now moving back. I came from the world of Class Bs. I'm moving back to Class Bs. Something that many of you on this call may not know is I'm a unique syndicator in that my larger portfolio is new construction. And I am extremely bullish on new construction in the United States right now. Believe it or not, we are about to close on a $21 million loan, which is currently at 2.9% for new construction. Because remember, there's no impounds for new construction. All impounds are for value adds only. Also, when I do new construction starting now, I get to skip COVID, which is truly awesome.
So when you're looking at Class B, let's say in Dallas, Class C is 100 a door. Class B, let's say, is 140 a door. Class A is 200 a door. Mm-hmm. What's the risk in Class B that people aren't building in right now?
I think the biggest risk in Class B is that markets like Dallas, note that I'm very specific here, the delta between Bs and As is dropping below where it should be. And that is risky because more and more deals that I'm seeing that are B, everything seems okay. I mean, I think I buy the rent pops, I buy the work that they're doing, but when they're exiting, the price at the end of the 5th year on a per unit basis is so close to cost of construction in the United States that why would somebody be buying that B at that point? I get why people are buying Bs at this point, right? Because you're buying at 140 a door. But the problem is your pro forma requires you to be selling this at 185,000 a door or $190,000 a door. So you're not going up just by inflation. You're going up at 3x, 4x the rate of inflation. And we're already seeing slowing inflation in the US. We're seeing slowing rent growth. As a result, I'm a little bit afraid that your exit price on a B is too close to construction price of an A. And I don't have an answer for that except to go into markets where land costs are lower and building myself.
Understood. Yeah, I saw a Fort Worth deal yesterday. All-in cost was 180 a door. So you're right on. Mm-hmm. Adjustments to underwriting post-COVID.
Obviously, we're assuming negative rent growth at this point, and that turns sharply. So it's negative rent growth from now until Q2 of next year, and then sharply turn positive. And I'll explain why. A lot of people are like, why aren't prices of multifamily going down? Well, that's because post-COVID, you've only seen the following months truly affected by COVID, and that's April, May, June, July, and August. So we've only seen 5 months of T12 out of 12. Next year, at the beginning of April, we will now have finally, for the first time, 12 months of post-COVID in the T12s. So I do expect that at that point to be the baseline where things turn around, both for prices. I also believe that by the end of Q1 next year, either a substantial portion of the US will have a vaccine, will have herd immunity, or will have heard enough about a vaccine to feel better about the future months, which is why I believe that you're going to see a lot of investment come into the US. You're going to see a upswell in the economy in Q2 next year. So I'm assuming sharp rent increases, from middle 2021 to middle 2022, and then it kind of flattens out. And I am not at all hesitating in saying the money that I'm going to lose on rent now, I'm going to make that up. When I'm looking at CoStar's projections, when I'm looking at, I've looked at Yardi Matrix's, CoStar's, I've looked at Berkadia's, and CBRE, all of them are showing sharp increases in rents in the second half of 2021. I'm in agreement with them, but I also believe that there's rent decreases coming in the next 5 months.
So you're okay buying right now and just building that into your model. And if it still works, it works. And you just absorb it for 6 months?
Yes, and the real reason why I'm okay with doing that is not my rent philosophy. It's my cap rate philosophy. So I'm going to just share this with you. My nickname in the multifamily industry is the mad scientist. And the reasons for that is I'm known for my opinions. I do not see how it is humanly possible for cap rates to be higher than they are 3 to 4 years from now. When you put $4 trillion, which is larger than the size of the US economy in any given year, and you inject that liquidity forcibly into the market with no plan to remove it, it's going to compress cap rates. Now, none of that compression is going to happen now. I mean, we're in the middle of a recession, so what compression? But when we end this recession, truly end it, right? So technically the recession in the US just ended because we had growth from the previous quarter, so it ended. But I think the true end to the recession is second half of next year. When it happens, I cannot possibly believe that with sub 3% interest rates, you can keep cap rates where they are today. Cap rates today are designed for a 4.5% interest rate design. If you stay at sub 3%, which the Fed has now made it very clear that they're going to keep the economy running hot for an extra 2 years, there's cap rate compression. Why am I buying today? Because I believe that there will be cap rate compression helping me.
So do you underwrite if let's say caps are 5% today, do you underwrite a 5% residual?
So I am still, in my underwriting is still assuming a 10 bips per year increase.
Right.
But that's because I can afford to do that. If there's a deal that's particularly group, I am not shy at all. I am not shy at all of dropping that 10 bips to 5 bips. But at 5 bips a year, increase 5 bips a year, it's 25 points increase over 5 years, I'm going to win that deal. Because most other people are still underwriting at 50 basis point increase in cap rate. I'm underwriting at 25, which means that I should be able to win the deal, right? I don't think I need to do more to win the deal. I don't think I need to show flat cap rates to win the deal.
Okay. All right. Identifying opportunities. I think we touched on this. Maybe talk on management.
I do want to point out a couple here. So very straightforward. I think today North Carolina, South Carolina, and Southern Tennessee are in a very, very good place from a macroeconomics perspective. And I do think that Texas and Texas, Georgia, and Florida will do well. I look at macro trends across the United States. I look at just Google what are the fastest growing states in the union. I'm so shocked. Every once in a while as an exercise, I'll go into a conference and ask a group of 5 people, what are the top 3 fastest growing states in the union? Almost always I get the wrong answers. Isn't it your job to know that?
Do you want me to answer that? I'm going to throw up Texas, but I don't know what the other two are.
Well, so at this point, the top three, Texas is always in the top five, so that's great. But
Yeah.
obviously, large economies like Texas slow down. So it's Idaho, Utah, and Nevada. I fully expect Nevada to drop from that list because it's taken an enormous hit. Idaho and Utah have done phenomenally well post-COVID. So usually the kind of states that we are more used to tend to be in the second, they tend to be, 3 through 10. Texas is in there, Florida's in there, and some interesting ones are in there, like Tennessee, because of the Nashville boom, will show up there. But most people don't talk about Tennessee.
Right. Cities in particular, I think we hit most of those.
Yeah, I think most of them. I think that true tertiaries are really doing well.
How does your strategy shift if Biden is elected?
I don't care. The president of the United States is not as powerful as the president of the Federal Reserve. That is my core belief. If you don't understand this, that the people that are running the feds in the world are now the presidents of the world. And doesn't mean that a president doesn't move things. Obviously, I am trying to be facetious here to make a point. But the power of the presidency has reduced a great deal because economic trends today are completely tied to interest rates. And there is no evidence of any kind that Biden even has a stance on interest rates, let alone, changing anything. The only thing that he could do that will hurt our industry is that he could take away capital gains, right? Cap gains is something that's part of his strategy. But am I going to change anything based on cap rates, on capital gain tax changes? No.
Okay. Best alternative to multifamily.
Timber. So the most profitable asset class in the world has always been timber. There's only one downside. It takes 13 to 17 years to grow a tree. But Google it.
What's the equity multiple?
So usually you make about 17%. Now people might say we make more in syndication. No, you don't. The average of 10,000 syndications is not 17 IRR. Right? There's lots of syndications that have made that. Also, syndications have made that in the last 6 years. Not enough of a time of a track record. But timber's making 17% for the last 100 years. Look into timber.
All right.
By the way, timber's not affected by worldwide price crashes. So keep that in mind. I think I've answered 8.
Okay.
Do value add work in the next 6 to 12 months if rents are declining? Absolutely. But don't let it slow down your unit turn. So my answer is yes and no. If you're with a property manager that's very efficient for unit turns, yes, keep doing them. If you're with a property manager that's not efficient for unit turns, stop. Because right now, what's going to kill you is vacancy. So if unit turns are what's causing your vacancy, just stick with classic. Wait until Q2 of next year and then start again.
So if you can turn it fast, then fine. But if it's
that's only like 20%
months.
of properties, right, James? I mean, in my portfolio, I have one property manager, in every 5 properties that's turning fast.
Okay. How did you get your first multifamily deal done, and then convincing that broker to award you the deal?
I said something to the broker that he remembered, and so I'm just going to say it. And I don't know if this works all the time. I'm just going to give you my personal experience. I said to that broker, I used to be a technologist for 20 years, gave that up to do this. I am going to be successful. So I can tell you, you might have a whole bunch of, bigger guys than me, but no one in that list is going to spend 100% of every single second that they have raising money and getting this deal done. I'm going to close this because this is my future. My future hangs on this deal. And if you can say that for anybody else in the list, award it to them. He awarded it to me.
That's the best answer I've heard in a long time. Best practices you're now using to improve your
my LASL system.
The LASL system? Yeah,
so the LASL system has now become CLASL. So, and in about an hour, I'm teaching LASL at the Asset Management Summit. And so it's still LASL that I'm teaching. But Mike, the answer is the LASL system was originally designed, LASAL stands for leads, which is the people that are interested, appointments, shows, S stands for shows, A stands for applications, and L stands for leases. So that's when I invented the system, I came up with Laisel. But now I'm switching, version 2.0 will be called Claisel. So the C at the beginning stands for calls. I find that if I don't understand how many calls are being made, then all of the other 5 metrics get hit. So I'm switching from Laisel to Claisel.
Great. Rising cost of insurance.
I have no way of navigating that except to write them into my pro forma. Please note that insurance costs are not on a one-time rise. They will continue to rise. In my mind, we have a decade of rising costs of insurance. And I really feel sucky about this because I am not buying in coastal states. I'm not buying, I'm specifically staying away from areas that get hit by a hurricane every, 7 years. But I'm still paying for it. So it really, really sucks. I mean, I feel really bad about this because I shouldn't be paying for it. I'm hopeful that within the next 5 years, insurance companies will split where they will have like Fannie Mae and Freddie Mac, they'll have a multiple tier structure. They'll say, if you want to go to this coastal city, here's your insurance. Right. But if you want to be at 200 miles inland, here's your insurance. Until then, I have no strategy because this is completely out of my hands.
Okay. Best technology for multifamily. I guess this is talking about management and leasing.
The best technology that you should be using, that's the low-hanging fruit, is called Sly Broadcast. Check it out.
Do you want to
elaborate?
Blasting. It's
Sly Broadcast is a voicemail blasting technology.
Okay.
Voicemail blasting.
So it goes directly to people's voicemail.
It does, and they see a missed call. And guess what people do when they see a missed call? They call back.
Best metric to look at before investing. I guess this is, let's say you get a package, you got IRR, cash on cash, total return. What should they be looking at?
I don't think this is a reasonable question. You have to look at IRR and cash on cash. I mean, I've seen deals where the IRR is really high and the cash on cash sucks. Well, you can't even sell the damn deal, right? I mean, so why even bother? The answer is these 3 metrics are so connected to each other, you have to look at all of them. Okay. So total return, I'm assuming, is equity multiple, right? So yeah. EM, IRR, COC must be looked at together.
Okay. Opportunity zones, are they worth it?
So the answer is in 90% of the cases, no. Opportunity zones looked at, if I look at every opportunity zones in the project in the United States in its totality, they're a freaking scam. Why? The government is conning you into putting money into depressed areas that have no population growth, no jobs, right? And in many cases are war zones. They're conning them into putting your money in there. And most people are like, but I'm saving taxes. What taxes? If your principal goes away, you didn't make any money. So what taxes are you going to save when you lost your principal? So I think 90% of opportunity zones in the world are in the US are just nonsensical. Now, there's 10% that appear to be completely normal. And you might say, how did they become opportunity zones? Because governors in the US were given the right to nominate up to 20% of opportunity zones just because their sister-in-law owned land there, or because their brother-in-law was building a building there. So of course, they misused it. So 10% of them appear to have nothing to do with the remaining 90%. So all you have to do is to go to investreal.com, investreal.com, and figure out which 10%.
And you don't own that website?
No, I don't. I don't have anything to do with them. I'm not invested in them, but they're pretty awesome.
Any trends in Texas that you're seeing?
Yes. So the San Antonio to Austin corridor is becoming the most powerful corridor in the US. For me, it was number 4 in the list 2 years ago when I list corridors in my training sessions. Number 1 was Central Florida, all the way from Orlando down to, I think it was Fort Myers. Number 2 was Denver going up through Fort Collins. Number 3 was Provo going up to Ogden. Number 4 was San Antonio to Austin. But today the situation has reversed. I think that corridor becomes the most powerful. So guess what? I'm looking at unincorporated land between San Marcos and New Braunfels, which is in the center of that corridor. These are not cities. They're not actual cities. They're unincorporated, which means that they have low taxes. So I'm going to go and buy a bunch of land there and sit on it because I can make a 5x return.
Do you have a fund for that?
No, I think blind pool funds don't work on those kinds of things yet. So I have to go back to the investors that I've made the most amount of money for. I'm going to go back to them and say, here's my vision. Do you buy into this?
So it's a bet on you.
It's a bet on me.
Yeah. Class A versus Class B versus Class C forecast for the next couple of years.
Class A is going to rebound very sharply next year. That's my belief. A lot of people, there's this nonsensical belief in the syndication community that when recessions end, C's do better than A's. Why don't you go back and look at the last 5 recessions? In 2008, A rents rebounded in 8 months. C rents took 4 years to rebound. So bottom line is, I think that A is suffering more now, and I think it's going to keep suffering for the next 8 to 9 months. Then you will see a sharp rebound on the A side. Why? Because new construction almost stopped in the last 5 months. I mean, we've seen almost a 40% decline, and now that cost of timber is high, that even may go higher than 40%. Well, you're not delivering enough high quality units into the marketplace. So I do expect second quarter of next year, first quarter of the year after to be really strong for A's. B's are steady Eddie, man. You can't go wrong with B's. C's, it depends on how long COVID drags on. But post-COVID, I think everything's going to do well for one simple reason. We went from delivering almost 300,000 units to 200,000 units. We needed that 100,000 units, right? But we are not going to deliver those because cost of timber is too high in COVID.
What do you see right now that is surprising, positive or negative in the market?
The biggest surprise was hugely positive is the Federal Reserve of the United States making a statement that I would have bet $1 million against, saying when inflation hits 2%, we're not going to cut interest rate. We're not going to raise interest rates. Do you realize how big a deal that is? I mean, that is basically the equivalent of somebody in California in 1948 saying, just so you know, there's gold that we have found over there, and that land is available to anybody that would like to go grab it. That's what the Federal Reserve said. When the Fed of the US refuses to raise interest rates when inflation goes above 2%, and it hasn't gone above 2% at all in the last 8 years, that is a guarantee for you that you're going to have fantastic cap rates when you exit. Then you should buy everything that makes sense to buy.
Buy everything.
No, that makes sense to buy. Hey,
that makes sense.
James, don't do the political thing here. You got to read the second part of the statement. You almost got me in trouble there.
Tips to finding a good property manager.
Do a nasty review search. So basically, never ask a property manager for their referrals. Ask them the questions in this sequence. Number 1, what are 3 largest properties that you're managing? He's going to name them. Then say, what are the 3 newest properties you're managing? After he names those 6, say, I would like to know the phone number of the owners of those properties. If he gives you 3 to 4 out of 6, he's a good property manager. If he gives you 1 out of 6 because you trapped him in this way, then he's a terrible property manager. Walk away. So many of them, if their referrals are not worth it because they're picking the people that are happiest in the buildings that have done the best, right? Once you do random picking and force reviews there, that's what tells you if they're a good property manager.
Got it. One technology that every owner should install to put us 10 years ahead of the competition.
I don't think any such technology exists at this point. I think that it's going to be modular construction. You will see focus on increasing density in the US, allowing you to build more in your apartment complexes in the future. And at that point, it'll be modular, but we're not there yet.
Class B cap rates in Dallas. I think we hit that. Down.
Steady Eddie. Yeah, steady Eddie.
Advice. New to mid syndication.
Well, learn as much about what James Eng does as possible.
All right. We don't have time. We'll hit these questions later. We have 1 minute, Neal. I'll let you close it out with whatever you want to wrap up with.
Yeah, so learn more. I have a whole bunch of interesting content online. Just type my name. I happen to be the only Neal Bawa on the internet, and hit enter. I think the 2 areas that people like learning from me, number 1 are the Real Focus system, which allows you to figure out the best cities and neighborhoods in the US. And you'll see why I picked Idaho Falls, Idaho, based on that system. Second is the virtual assistant system. I have 18 full-time employees. I tell you what I do with them to 10x my business. And the third one is the LASL asset management system that one of the people on this call mentioned, which allows us to manage our properties better. So I am actually going to go teach that LASL system right now at 3 o'clock. So I'm going to jump off.
All right, Neal, thanks a lot. I'm going to hang on for a little bit just to answer questions, but Neal, thanks for jumping on, and we'll see you at the conference in a couple weeks.
Thank you.
All right, see you, Neal. All right, guys. So now we can say whatever we want about Neal, but no, I thought he did a great job. I love to just go around, and maybe we will try, if you guys are open to it, the 60 seconds. I was taking notes over here. The 60 seconds, what was it? He said the 60-second haves and wants. So in 60 seconds, tell me what you have and what you want. And we'll just sort of go around and play that game for people who are willing to play it. So anybody want to raise their hand or go first? I would love to hear what you have and want.
All right, I'll go for it.
Go ahead,
Okay.
Alan.
All right, so haves. So I was a 20-year corporate guy, and I have retired from that a little over 2 years ago. I have done 5 syndications, sold 4 of them. They've been excellent. Still have one that I'm actively managing. I'm invested in another 11 passive deals. And so what I'd like to do is continue syndicating as well as investing passively. I'm going to be focusing, looking forward on A- deals in DFW and Austin. And, you know, I live in DFW, and I think it's a great place to be.
All right. All right. I'm just going to call on people. Nika Huffman, are you there? There you go.
Hi.
Hey.
I'm working out of a coffee shop today, so I don't know if you guys can hear me or not. There's some background noise.
You're good.
Okay. All right. Well, I actually work for an investor, so I don't have anything. But the investor that I work for has done lease to own successfully for about 10 years now, and is just looking to get into multifamily, and they want in the next 5 years 100 doors, actually somewhere in the San Antonio area or surrounding market.
All right. Let's see. I think Chris is on the phone. Eric?
Hey, James. So other than having some crazy hair today, I've been in single family for about 11 years, and I'm trying to make that switch over to multifamily. I have properties. My portfolio is split half between Oklahoma City and Pensacola, Florida. That's in the Panhandle right next to Alabama. So I have some experience in single family, in managing projects remotely, managing properties remotely. I manage all of mine and the additional properties that my girlfriend owns down in Florida as well. What I'm looking to do is I'm looking to meet other multifamily investors, just like everybody in this group here. I'm trying to get started. As you may or may not know, I joined the Sunmark group here recently, and so I'm trying to get, I've got my mentor there, and I'm trying to get networked in with a lot of this industry on several different levels, both on the people that are already doing it. And of course, I'm trying to network with potential investors and reach out and trying to grow as a person. I really don't have this network of high value friends like some people do. So I'm really trying to branch out and expose myself to people in other groups and other business that may be a little more high value than the people I hang out with currently. So trying to.
And where are you based again?
Mainly in Oklahoma City, but also in the Northwest Florida, the Panhandle there, Pensacola. But I'm sitting in Oklahoma City right now.
Let's see. Craig Carlson?
Hi, I'm Craig Carlson. I'm in San Antonio. I just retired earlier this year as a dentist, so I have a lot of high value friends, Eric. So I'm in 14 syndications as a passive, as a KP, as a sponsor, and I'm just looking to continue on this road. We're closing on a deal in San Antonio, 88 units on October the 14th. And I'll be asset manager or part of the asset management team on that. And so I'm just enjoying life as a retiree, but I've got a new passion in life. So real estate is keeping me young in spite of my gray hair. So I'm happy to be here. And James, thanks for putting this on and having Neal. And it was great. Thank you.
Thanks for being here. Let's see. Layla?
Hi, everybody. Hi, James. And James, thank you for putting this together. This is a lot of fun, a lot of good information. My name is Layla. I'm based out of Seattle, Washington. Here's what I have. I have a portfolio of single-family homes that I have owned and managed for 15 plus years. The income from that portfolio has replaced my W-2 job. I am looking to invest in multifamily full-time. I have the time, the desire, and the capability to learn. And I'm willing to invest a lot of my time to become good in this space. Here's what I want. I have capital to invest, and I want to find good deals to invest in. I also look for potential partners to start syndicating my own deals. If you haven't connected with me, please do so. I love talking to people, and I can always find some time. Thanks.
That was the best 60 seconds I've heard in a long time. So thank you, Layla. Maybe put your, if you haven't, put your contact info in the chat so people can reach out to you after you give your sort of 60 seconds. That'll probably be the easiest. People can just write it down right there. Chris DeSell? I don't know how to say your last name. Are you there?
Yeah. Sorry, Chris DeSell, you nailed it. Yeah. Thanks, Chief.
Yeah.
I feel like I know you and Paul and the rest of the gang at Old Capital, the governor and stuff like that. So thanks so much for having me here today. I really learned a lot, always from you guys. And Neal, I learned a big chunk of my underwriting from him. So he's a pretty sharp guy, man. So thanks for that. But we're presently pulling down. We have 2 deals that we're working on. We're pretty close. We put 2 offers in. One in Ohio and one in Texas, and I might need some help capital raising because I thought I was going to have enough to pull down one deal, and then the other deal came at the same time. So I'd like to do them both, but I might need a little help capital raising. But I'm an LP on 2 deals, and I'm a GP on another, and these will be I'll be the keys on these next 2 deals coming down. So.
And where do you live?
I live in San Diego and Los Angeles. We primarily do value add apartment complexes out of state because I'd love to invest in California, but the rental laws are just they're crazy. You can live for free and it's the law for almost a full year. And if you're the owner, you have to eat it. That's like the written law. And it's just not fair.
Where's the deal in Texas that you're looking to buy?
It's outside Houston, and then the other one is in Ohio. It's what's the town? It's outside of Cincinnati. So
okay. All right. I'm gonna go to Yoshiaki Sasaki. Thanks, Chris.
Hello. How are you, everybody? I'm an asset manager based on the investors live in Japan. So I'm very new to those syndication in the United States. So I want to learn a lot from you guys and move on from Japanese investor to, the US investor world. Thank you very much.
So Yoshi, you live in Dallas?
Yes.
Okay. All right. Welcome.
You see.
Yeah. Welcome to Texas. All right.
Yeah.
Let's see. Malay?
Hey guys, this is Malay. I live in Los Angeles, and I've been doing single family for about 16 years or so, and I do notes and some hard money lending. my partner who lives in Dallas, so him and I are looking to buy 4 million or 40 units or less property in Dallas. So if anybody has any properties, I would love to take a look at it. The plan is to just do this, learn the ropes and be KP if possible, and limited partner if possible, and learn from that side and do the syndication.
All right.
And I do IT consulting. That's what I do. I actually have an IT consulting company that I run.
Great. Let's go to Joel Fine. I can't hear you, Joel.
Oh,
there you go.
All right. Hi, everybody. I'm Joel Fine. Sorry about the audio problems. I've got a portfolio of small multifamily properties in Ohio. I live in Texas. So I've got good experience managing assets from a distance. All the properties that I bought were fairly distressed when I bought them. So I've also got some experience managing rehabs and renovations from a distance. What I'm doing now is I'm shifting my focus over to large multifamily. And so I'm starting to underwrite as many deals as I can in the Texas Triangle. And what I need is deal flow and potential partners with more experience than me who I can pair up with and learn from. I've got plenty of time. I've got a good amount of capital, and I've got the energy to manage the asset and some experience at least managing the small multifamily.
Where do you live, Joel?
I live in Austin.
Live in Austin. Okay, perfect.
Yep.
All right, let's go to Brandon.
Hello, everyone. Thanks, James. That was a great presentation. I am living in Atlanta. I recently closed and am currently renovating my first multifamily, a small multifamily, 2 units in the metro area here. I'm looking for partners that have more experience to be able to tackle larger deals. Very interested in the Texas market, but still currently underwriting in Atlanta, and I'm an engineer full-time. So very analytical in nature and very good with underwriting.
All right. Thanks a lot. Coming in from Atlanta. Love it. Let's see, Farouk.
Yes, hi. I live in a suburb of St. Louis, and what I bring to the table is that I have invested in about 6 deals passively. I own another business, and I have some capital, time, and energy. What I'm looking for is a co-sponsor who's more experienced that I can partner with, and so we can syndicate the deal. I can raise some capital, some capital through friends as well. That's about it.
All right, let's go over to Marcus.
Hello, everyone. I'm up here in Woodbridge, Virginia area. I'm purely a limited partner investor. That's all I'm interested in. And that's what I'm looking for, but only for select operators, i.e. has done at least 2 cycles with investors that you pay back their funds on. And that's in a nutshell. That's the minimum requirement, that is. Thank you.
All right. Hamad?
Hey, how's it going? Thanks for putting this together. Always love listening to Neal as well. I've listened to you a couple of times as well, James, especially the underwriting bit has been great. I'm also part of Julie's meetups as well. So for me, I'm actually based out of Detroit. I'm originally Canadian. I've been in Detroit for the past year. So in Canada, I used to do conversions of single families into legal duplexes. And right now, I'm purely just focusing on the multifamily business. I used to have my W-2 job. I just left a couple of weeks ago. I worked for a couple of well-known chocolate and include recently the company that makes Oreos. So yeah, I just left my job a couple of weeks ago, and I'm purely focused on multifamily business. So I have time, energy, and a little bit of capital as well to put towards it. And right now, just based on some of the things Neal said, and like personally, I think we're going to see a lot of distress even in multifamily next year. And so from that, a lot of opportunities with people who've over leveraged. So I'm just trying to work on some capital raising, trying to build up the back end of my business to be ready for that for next year. And primary markets is Texas, Austin, San Antonio, Dallas, and then also if anything comes up in either Florida, Carolinas, Georgia. That's it. Looking at like 100 to 150 plus units.
Perfect. Any questions about anything? Multifamily, the conference, anything? I'm happy to answer those before we jump off here.
Yeah, I have a question, and you can answer it, or anyone on the call can feel free to answer it. Have you looked at, in terms of return on investment, investing in new construction, single family homes, purely for rental, turnkey, and kind of the ROIs in hot belt states compared to what traditionally can get back on large multifamily investments? I'm starting to look into that, but I'm just curious as to what others might have found in terms of ROIs when comparing the two.
Sort of that build to rent single family is what you're talking about, Marcus?
That's right, brand new construction, yeah.
I mean, I've seen it here in like the DFW area where they've put it in more suburban locations. So they've been 20, 30 minutes, in Plano or McKinney or Allen, which is, the suburbs. And the hard thing is to build like a single family that's like a 2-bedroom, 2-bath. It's pretty freaking expensive still. And so the price per door on those deals is, north, 200 to 250 a door. So you're competing versus Class A. So their rents are very high. So Class A deal, average rent's probably $1,500. On those properties, it'll be $1,700 or $1,800 per unit, average rent, but it's a completely different demographic that you're looking at. And so we just haven't really, it's more comparable, I would say, to Class A, but it probably has a little bit more uniqueness to it. So it's not, you're not going to be competing like, for, a property type that has like 60 or 70% 1-bedrooms, which is what a lot of new construction has. And then the amenity set is usually just, a pool and a gym, and that's it. And so, but we've had, so a couple of new developers who are doing that reached out to me, and they haven't necessarily, Fannie and Freddie haven't necessarily figured out how to finance that as well. So Fannie and Freddie, they usually finance on the multifamily side 5 units and above. So when you all have all these like buildings that are just individual units, that might be a little bit more difficult to finance. So Fannie and Freddie haven't quite figured out that niche yet. And so people are having to do just like bridge loans on it or CMBS loans.
Sure.
James, how's the deal flow compared to pre-COVID now?
It is all the way back. The deal flow is all the way back. So I would say, March, April, May, it was pretty dead. June trickled back. So like in DFW, let's say there was 20 to 25 deals on the market in January, February, pre-COVID. In the last 2 months, there's that many deals or more right now on the market in DFW. And the deals are going at whisper or a little bit higher right now. So it's back.
Hey, James. Yeah. I don't think I said it earlier, but I'll make sure I say it. Thanks for putting this together. This is good stuff. Appreciate it.
No problem. Thanks for being here.
You got it. Is there what's the current word on the street with Fannie supplementals and just general pricing and general, they still requiring impounds and all of these things, or what's the fuss there?
Yeah, so Fannie and Freddie, they both require, Freddie is 9 months P&I. Fannie is 12 months if it's above 6 million. If it's under 6 million, it's 18 months of P&I. So they still have those in place. They haven't changed those. And, supplemental, you can go out and get a supplemental, but you still have to put a reserve up based on your total loan amount. So that usually takes away half the supplemental, because supplementals are usually smaller. So, and then the pricing usually is about 150 basis points more than current. So if, like, let's say current interest rate is 3%, you're probably at 450, my guess is, on a supplemental in terms of interest rate. If you're doing a cash out on a supplemental, most people are just waiting because half of it's going to a reserve. If you're doing an acquisition, you're doing an assumption plus a supplemental, it might make sense if the supplemental is big enough to just put up the reserves as well.
Yep. That makes sense. Thanks, James.
All right. If no one else has any other questions, thank you for joining. The next one will be next Wednesday. We will have someone just as smart as Neal on, JP Conklin, who writes one of the best letters. If you do not subscribe to his newsletter, go to Pensford, Pensford. He puts out a newsletter every Monday, and it's probably one of the best on interest rates and what's going on with interest rates. So we're going to have him on this call next Wednesday. And then also we just set up the Whova app. So WHOVA. You should be able to download that app. It'll have the full agenda, and then it'll have every attendee that is coming to the conference on that app. So you should be able to somehow connect with them through that app. So if you haven't downloaded that app, download the app. And if you have any trouble with that, let me know. But we'll probably send out an email with the link for it. But if you just go to like the Apple Store or Google Play, you should be able to download that app and find it right there. And that is it. Thanks a lot for joining, guys.